Hello friends, welcome to my channel. So, in this video, I'm going to talk about. In this video, I'm going to talk about what is the class 12th Cbse macroeconomics chapter 5. So, revision. Let us do a small revision here. That is chapter that is government budget and the economy chapter is. So, first, let us know what is budget. So, budget it is a year-long financial report that explores how future revenue and expenditure will be calculated item wise. The budget details a country's revenue and expenditure, how much a country has earned and how much it has spent money for the society and for the welfare of the society, for the growth of the economy, how much we have spent, we know by the budget. So this is 1 or 2 marks question they may ask. So 1 or 2 marks, let us see. Let us keep it as 1 or 2 mark question. Next, main objectives of the budget. What are the main objectives of the budget? If they ask, they are the resource relocation, income and wealth redistribution, public sector management, economic stability, economic development, employment creation. So the budget, it is the use objectives of budget. They are the resource reallocation, means getting the resource back, and and income and wealth redistribution. So income and how much money we are getting it back to the welfare of the society, getting the income back, how much they have spent, getting the income from that, and public sector management, managing the things that need for the public society, for the welfare of the society, and making economical stable by earning the profit, and by making the money, making economy stable, so that if they should not have any loss, otherwise there may be a fall of economy. And economic development also, they do a development of the economy, and employment creation, so that they can give new jobs to the employer, so that they can work for the welfare of the country. Next is two components of budget. The two components of budget, these are the two marks they may ask. Revenue budget and capital budget are the two components. Revenue budget, the revenue budget is made up of the government of India's revenue receipt and the expenditure that are met with that revenue, how much expenditure they have done, government of India, and how much revenue they have got. And capital budget, it is the capital receipts and payments are included in the capital budget. It is also includes transactions for the public account, from the public account also transaction it also includes. These are the two components of budget. Next is budget receipts. What are the types of budget receipts also they may ask. The revenue receipt. First is the revenue receipt. In this revenue receipt, what it is, those that do not result in the liability or a decrease in assets, means it does not decrease the liability and assets, means income does not decrease. And the revenue is then split into two categories. The revenue, it will be split into two category: direct tax or indirect tax. Direct tax, it is a taxpayer pays directly taxes in full to the government. If the taxpayer pay full tax to the government, how much you want to pay, he should pay that full tax. If he pay to the government, then it is called as the direct tax. According to types of tax charged to both the central government and state government, they will collect the tax. How much tax is charged, both central and state government will collect in the direct tax. In indirect tax, the end consumer of products and services is ultimately responsible for indirect tax. Means if you buy a product, they will include tax in that, right? So that tax, indirect tax, the company will take and it will give to the government. This was the basic thing of the government. Next is second is the second receipt is the revenue. After revenue receipt, the second one is capital receipt. Okay, in this capital receipt, government, these are the government receipts that create liability or deplete financial asset. The main source of capital receipt or loans, means capital receipt loans that are taken by the public, or borrowing from the market, or reserve, how much loan reserve bank or the banks they have taken, commercial banks, and how much loan savings bank, how much loan you have taken, whether it will be loan from the bank or how much loan uh, means the government has given for setup of small industries, small scale industries, or government have given for the banks who are in the loss if they have given some loans like this. These are the capital receipt, revenue receipt, the revenue that government gets. Next is budget expenditure. This is also an important question. So budget expenditure, it is revenue expenditure and capital expenditure. In first revenue expenditure, the nature of revenue expenditure is generally current or short term. It means it is for short term or for some time. They are cost that the government must incur to carry out its daily operation. So it is the cost that government must pay, must have so that it may do its work daily, easily, smoothly. The cost are fully charged in the year they are incurred or not depreciated over time. It is full time, they are not incurred. And the capital expenditure, that is expenditure or one time investment of money or capital made by the government. Means one time the government will put the money, not like a revenue. They have to pay for short time money they have to give like that. One time they will pay, one time they will give, and business in order to create profit. One time pay they will do to the business, like for short term businesses they will give some small amount of loan for some one time. Then the loan will be paid by them, and the how much the interest the government or how much interest they will take, that much revenue they will get. Next is budget deficit. The budget deficit, it is the amount by which a budget expenditure exceeds its revenue is referred to as budget deficits. The amount by which budget expenditure exceeds means the expenditure how much the government has given, means for the for the development of the country, how much budget they have given. If that expenditure exceeds its revenue, means how much revenue they have got from the sectors like working sector industries, how much revenue they have got, tax revenue. If the expenditure is more when compared to tax revenue, it is referred as the budget deficit. This deficit is good indicator of the economy financial health. Means how, means if it is like, let us take an example, like budget expenditure government have given some 10,000 crore like that for the year 2022 and 2023. And if they calculate in the end of 2023 when they want to leave a new budget, if that time if they calculate how much we have got the income, means how much we have got the revenue, if they have got money less than 10,000, we can say that the government had taken some of the loss. If they have taken the profit, means if they have budget, means the revenue, sorry, if the revenue they get, it increases 10,000, about 10,000 crore, if they have given no budget, if it increases, let us take it is example, okay, if it increases about 10,000 crore, they got profit, then we can say that the government has got profit, and that profit they will use for the next budget. This is this is the good indicator where we can say the financial health, how is the economy in the country, or how much the financial stable in the country. Financial stability is there or not in the country. We can expect. We can tell by using this budget deficit. So this is also important, budget deficit, 1 or 2 marks. Next, revenue deficit is also there. Revenue deficit is defined as the difference between total revenue collected and the total revenue expenditure. Means the total revenue collected, how much the revenue is collected, and how much the total revenue is expended, how much the total revenue that they have collected in the last year, how much the expenditure they have given for them. Only current income and current expenses are included in this deficit. Only current how much income is getting and how much deficit is they are getting, only that is used. And this is the formula: revenue deficit is equal to total revenue expenditure minus total revenue receipt. Okay, this is the formula. Next, okay, here, okay, implications of revenue deficit, or what are the implications also they may ask. A significant revenue shortfall indicates budgetary indiscipline. If the revenue falls, shortfall, it indicates that budgetary, we have not given budget correctly. Next, it indicates that the government is utilizing savings from other sector of the economy to pay its consumers expenditure. Implementation means it indicates that the government it is utilizing their money for some other sector so that it can pay to the consumers expenditure. Then it demonstrates the government excessive expenditure on administration. On administration, if the government is using more money for the administration of the government, then we can know through the revenue deficit. And it lowers the government assets owning the disinvestment. So owning the disinvestment, it brings down the government assets, means the government profit. Next, it is a significant revenue deficit sends a warning signal to the government to either cut spending or boost the revenue. So, due to this revenue deficit, the government will know whether they have to getting loss or not. So that if they are getting loss, how to overcome that loss, how to what are the solution they can do, they will come to know. Next is fiscal deficit. A fiscal deficit it occurs when the government's total expenditure exceeds its entire revenue produce, means the total expenditure how much the government has done exceeds its revenue produced. The government borrowing however are not included. So this is also same, the fiscal deficit is means expenditure exceeds. Here 1 minute, let us come back. Here in the 1 minute wait. Here in the budget expenditure exceeds its revenue. Okay, it is referred as the budget deficit, right? In the wait, wait. The implementation, so this is the fiscal occurs when the government total expenditure, how much total expenditure government has done, it exceeds its entire revenue produced. If the government expenditure, how much they have done, if it exceeds the total revenue they have got produced, then it is called a fiscal deficit. Formula is fiscal deficit is equal to total expenditure that government have done and total receipt excluding borrowings, how much the government has done or the government has given. If it increases, then we can call it as fiscal deficit. Implementation of fiscal deficit or a significant drawback or consequence of fiscal deficit is that it may result in the debt trap. It may result in the debt trap. It can cause inflationary pressures. It stifles future advancement. It increases reliance on foreign resources, means taking more foreign resources. It raises the government's obligation. So these are the problems of fiscal deficits. They may ask. In this primary deficit is there, it is derived by subtracting increased payment from the fiscal deficit. Means primary deficit is equal to fiscal deficit minus interest payment on previous loans. On previous loan, how much interest payment they have got, it will be primary deficit. Implementation of primary deficit is it reflects how much of the government's borrowing will be used to cover cost other than the interest payment. How much the government borrowings they have done other than interest payments and other things. Next is the measures to correct different deficits. To how we can correct these different deficits, how government will correct these different deficits is uh, government subsidy cuts will aid in reducing the deficit. So government subsidy cuts will aid them in reducing the deficit, and where assets are not being used efficiently, assets will not be used efficiently where, and disinvestment should be disinvestment should be carried out, and borrowing from both domestic and international sources, and increasing emphasis on taxes based revenue as well as necessary steps to prevent tax evasion. These are the steps government may take so that they can remove the deficit. Next, fiscal policy. Keynesian economics, a theory developed by economist John Maynard Keynes serves as the foundation for this fiscal policy. It is the system by which the government makes change in its planned expenditure and tax rate in order to the so that they can monitor and they can influence the performance of a country's economy. It also depends. So it is not important. You can just have a look on it. Next is debt, a quantity of money borrowed by one entity to borrower from another entity to lender. It's known as debt means a money that is borrowed by one company. They are the borrower from another company who is the lender. He is giving the money. It's known as the debt. Government borrow money to cover their deficits, which allows them to fund regular operations as well as large capital expenditure. Also, this debt might be in the form of they can take loan or bond issues, issuance. They can make bond that this much year within this much year we can play, or they can also take as loan interest. So this was your chapter, the government budget and the economy revision. So a small revision. So if this video was helpful to you, please give a like and also share my video with your friends so that it will be helpful to your friends also. So okay friends, I will see you in my next video. uh, so till then, take care, have a nice day, bye my dear friends.